Good morning. Before I get started, I wanted to thank Commissioner Kreitler for inviting me to participate in this very important climate summit. It's an honor to be able to speak to such a large and influential audience of regulators, policymakers, business leaders, investors, academics, and climate scientists. I also want to thank everyone associated with producing this virtual event for their help and assistance. And finally, I want to mention that my comments today are my own, and that I am not here representing or speaking on behalf of any company, insurance department, or any other organization. The commissioner asked me to share my thoughts on climate and the insurance industry from both a regulatory and industry perspective. So let me start from the regulatory side and then move on to some key initiatives in the insurance sector that companies are employing in order to address the growing threat of climate-related risks. By way of background, I was appointed Connecticut's insurance commissioner in February of 2011. In the early days of my tenure, I felt like I was drinking out of the proverbial fire hose every single day. There were so many issues to deal with, and trying to figure out which were the most important and how to prioritize my efforts were somewhat overwhelming. These included the passage of the Dodd-Frank Act in the aftermath of the financial crisis, implementing the new healthcare law and assisting in the creation of the state's health insurance exchange, the NAIC's Solvency Modernization Initiative and its many components, including revisions to the Model Holding Company Act, own risk solvency assessments, enterprise risk reports, supervisory colleges, as well as fast-moving international regulatory proposals regarding capital standards, systemic risk designations, and a variety of other initiatives that all could or would have significant impact on the industry and consumers. Now, you'll note that climate was not on my early list of challenges, but just a few short months after I assumed office, and in the midst of all these other challenges, two events occurred that put climate-related issues front and center for me. The first was in August of 2011, when Tropical Storm Irene inflicted enormous damage, not just on coastal Connecticut, but throughout all of New England, dropping copious amounts of rain inland, resulting in what was then unprecedented flooding and devastation. I remember the day after the storm, walking door to door along the shoreline with the mayor of East Haven, meeting with distraught residents who in many instances had lost everything, their houses completely washed away and only foundations remaining. Within 90 days of Irene, and again within 90 days after Superstorm Sandy, which also inflicted very heavy damage on my state a year later, insurers had already paid nearly 95% of all Connecticut claims received. This is very significant because it allows communities to rebuild more rapidly and maximizes resiliency. A year later, I went back to East Haven with Governor Malloy, and we met with residents who were recovering from the storm, many of whom had already begun to rebuild their homes. One person who was not rebuilding, however, was an older gentleman whose house had been destroyed. He told us that he only bought homeowners insurance because his bank required it. So when he paid off the mortgage the year before, he decided he no longer needed to continue making these insurance premium payments and decided not to renew his policy. And so he had no funds to rebuild. A tragic story indeed, but it highlighted for me as a new commissioner in no uncertain terms the role that insurance plays in resiliency and recovery. The other event was a call I received from Commissioner Kreitler that same year. While I was in my first year as commissioner, Mike had already served for a decade, and even back then was one of the most experienced members of the NAIC. He was also a leader at that time in the regulatory community in terms of understanding the impact of climate change on the insurance industry. He and then California Commissioner Dave Jones were working on a proposal at the NAIC that would require insurers to file a financial disclosure that would reflect the impact on climate-related issues on a company's business. It was not gaining sufficient traction at the NAIC, so they asked me if I would support the initiative. You see, even though it was not likely to become an NAIC requirement at that point in time, by having the regulator of the country's largest insurance market, California, and the regulator of the second largest insurance industry in the country, Connecticut, agreeing to join Washington State in mandating this disclosure would effectively create a national requirement. Now, looking back a decade later, it's hard to believe this disclosure initiative could have been controversial, but it was. The key point was that we, as regulators of this critical industry, did not know what the real impact of climate change was on the companies that we regulated. Not just on the liability side in terms of claims exposure, concentrations of risk, and liquidity, but also from the asset side of the insurance balance sheet in terms of risks embedded in debt and equity securities of the companies in which the insurer's investment portfolios were held. I thought this disclosure proposal made great sense and agreed to join on as the third member of the group of regulators supporting this initiative. I will admit that I had some trepidation in advance of my calls to the executives of the large property casualty companies I regulated in telling them that I was endorsing the disclosure requirement. To my delight, the response from those companies was very supportive. They pointed out that they are first and foremost in the risk business, and that climate change and global warming were undeniably increasing risk worldwide. The increasing frequency and severity of storms left no doubt about that. And they were, as a matter of good business practice, tracking this risk to their assets and liabilities. So taking internal data and using that in a public disclosure document in and of itself would not present a significant burden or issue. The disclosure was eventually adopted by the NAIC. And today we have several disclosure reporting frameworks, the most prominent being the Task Force on Climate-Related Financial Disclosure. A TCFD, as it is known, is where companies set forth how they identify, assess, and manage climate-related risks. In many instances, companies already were providing the information contained in a comprehensive TCFD, just not in one place or one document. This information was often contained piecemeal in their proxy reports, other SEC filings, annual reports, 10-Ks, press releases, and similar public documents. Bringing all of this together in a well-drafted and comprehensive TCFD report makes it a far more streamlined process for the company, and it allows its various constituents, from regulators, shareholders, employees, and investors, as well as the general public, to look to one place where all this information is readily available. In fact, the NAIC now allows a company to file a TCFD to meet its disclosure requirement without having to file the original NAIC disclosure form. But that initial disclosure, championed by Commissioner Kreitler over a decade ago, was critical to this development. And it continues to be imperative that insurance regulators have the information and tools needed to fully assess the risks of those companies that they regulate, and that insurers continue to refine their reporting and use it in practice to continually improve and enhance the effectiveness of their climate strategies. Let me turn now from the regulatory view to the industry perspective. Property casualty insurers are in the weather business and have been at the forefront of recognizing the risks associated with climate change for a long time now. It's critical to their bottom line and to their shareholders, employees, customers, and, as I just mentioned, to their regulators. Their business and success depends heavily on understanding not only the current risk environment, but also how climate change is most likely to impact risks in the future. The industry has a number of third-party modeling companies like AIR and RMS, but virtually all large property casualty companies also have highly sophisticated proprietary models tailored to their product line and specific geographic footprint. These companies are insuring individuals and businesses against the impact of wind, wildfires, drought, floods, and other risks. So it's critical for insurers to have a deep understanding of the factors that impact their underwriting and pricing decisions. They look to underwriting volatility, concentrations of risk, they model out expected losses, and they maintain a deep database that provides insights into how risks perform over many decades, including the most rapidly changing impacts of advancing global warming. On the asset side, many companies hold investment portfolios that are heavily invested in highly rated bonds and other debt securities, and these portfolios turn over quite frequently. So while the liability scenarios have a long-term view of 40 to 50 years out, the short duration of the asset side of the balance sheet allows companies to adjust their investment portfolios much more rapidly as the evolving risks require. But insurers don't stop just there. Risk management, resiliency, innovation, and product development are other ways in which insurers help their clients to address the growing risk posed by climate change. Historically, the industry has stepped up to use technology and risk management capabilities to help reduce risks in all sorts of areas, from auto and road safety to fire prevention, worker safety, and so on. Let me share some examples. Innovation in capacity and coverage is one. Over the past decade, insurance-linked securities and catastrophe bonds have become a major component of worldwide economic support for both risk underwriting and claims payments. While there was some skepticism about the long-term viability of this product, for example, what happens when interest rates rise or when substantial losses are incurred by investors, would the cat bond market retreat or disappear? That clearly has not been the case, as insurance-linked securities now represent more than $45 billion in global insurance claims paying capacity. Another innovation is that many of these cat bonds and ILS instruments utilize parametric triggers, for example, using pre-agreed upon levels of wind speed or rainfall amounts as parameters as to when coverage automatically applies. And this drastically reduces coverage disputes and speeds up claim payments. Infrastructure is another example, as insurers are one of the most significant investors in worldwide infrastructure projects, financing both new infrastructure in emerging growth countries and in rebuilding or replacing aging infrastructure in developed nations. And in some cases, these same insurers are the leading underwriters of the risks associated with these massive projects. Insurers are providing workers' compensation policies, property, liability, surety bonds, and other coverages. Another example is building key partnerships, since the insurance industry can't solve all of these problems alone. One company has paired with a leading engineering firm and a high-profile nonprofit to help build resilient cities, while another partners with an environmental nonprofit to plant over 3 million trees in an effort to combat the effects of global warming. Insurers' involvement in the Insurance Development Forum, working in concert with the World Bank and the United Nations, is another example where the industry is helping to assist developing nations with solutions as to how to increase insurance penetrations in a commercially reasonable way. This is key because a high insurance penetration rate signals a much more resilient community than one with little or no insurance. Other examples are providing funding for the Wharton Risk Center, the Insurance Institute for Business and Home Safety, and the Build Strong Coalition, among others. Another example is through education, awareness, and transparency. Insurers need to explain on a large scale how insurance can be a mechanism to address the impacts of climate change and build resilient communities. But we also have to understand that a large part of the problem is embedded in socioeconomic factors and in public policy, things like building codes, population growth, and the population density in high at-risk areas of the world that put people and infrastructure in harm's way. While the industry is not a significant carbon emitter in and of itself, many insurers nonetheless have focused on reducing their own corporate carbon footprint by upgrading offices with high-efficiency lighting, using sustainably manufactured products, and energy-efficient mechanical infrastructure and computer server technologies. Companies are all supporting the transition to a lower carbon footprint by developing products that encourage the use of renewables like wind and solar, using their investment portfolio to invest in green technologies, and by promoting stronger building code standards that can help withstand current and future severe weather risks and grow and create greater resiliency. Some insurers are funding education and awareness campaigns to help foster a better understanding around issues like preparedness, coastal risk, and flooding. Lastly, in very severe storms, it may be quite a while before roads are cleared and make damage assessment possible through live in-person inspections. The use of technology has enabled insurers to assess damage and accelerate the claims payment process using drones and artificial intelligence in place of actual live visits. So all of these efforts in disclosure, innovation, partnership building, education, product innovation, and technology highlight some of the ways that the industry is leading on addressing climate-related issues. I hope you found these comments helpful, and many thanks again for the opportunity to share my thoughts with all of you today. Thank you.